Assalamu alaikum. Welcome to the latest episode of Wahed Wealth Digest. My name is Shiraz Noor, portfolio strategist here at Wahed. In this series, we break down the key economic events and global market updates and how this could impact you as an investor. Let's get started. Markets continued their year-to-date rally in July as more investors continued to move away from their defensive positioning to start the year. The MSCI World Islamic Index rose by 2.8% in July, while the Dow Jones Sukuk Index rose by 0.2%. Over the course of the month, many asset managers and economists who at the beginning of the year predicted a recession in the US then walked back their predictions. This was due to the combination of continually strong payroll earnings data and falling inflation. On July 12th, the Consumer Price Index data for June showed that inflation in the US cooled dramatically, with all CPI indicators showing more decline compared with expectations, and sharp declines compared with previous periods, as per Bloomberg. The markets rallied on the news throughout the remainder of the month, with the rally expanding globally as well. The following week, UK data showed that overall inflation decreased compared to predictions. This inflation news was significant because the UK's inflation has become elevated versus its developed market peers. And the cooling of inflation in the UK was seen as that final shoe to drop in the central bank's fight against inflation globally. Meanwhile, throughout the month, companies reported strong quarterly earnings, which were driven by strong consumer demand and cost containment. Notably, over the last several quarters, it's become clear that during the pandemic, when interest rates were at record lows, corporate finance managers took the opportunity to refinance their debts at lower long-term fixed interest rates, where such refinancing resulted in interest costs of many large corporations actually decreasing since the pandemic, even as interest rates have risen. Prudent corporate finance management has allowed large corporations to maintain and increase payroll costs, which has supported employment levels during the rate hiking cycle, contrary to expectations. As a result of these developments, the S&P 500 rose by 3.1%, while the MSCI All-Country World Index, excluding the US, rose 3.7%, according to Bloomberg data. This is despite central banks such as the Federal Reserve hiking interest rates during the same month. Many asset managers and economists now believe that interest rates were at or near their peak, and that central banks would likely succeed in reducing inflation and slowing down the economy without triggering a recession. This is what is known as a kind of best case scenario in this type of rate hiking environment. Meanwhile, in China, although the economic data has continued to come in with weak metrics, the markets were lifted by the Chinese government's announcing economic aid to support a rebound, including extending loan relief to the property market and easing home buying restrictions. Heading into August, while much of the economic data has been positive, much of this good news has already been reflected in market prices, which have been recovering since the beginning of the year. There may be a good chance the markets will start to level off or pull back as investors lock in gains and become potentially more sensitive to bad news. Additionally, there are signs that markets may be overestimating the current economic outlook in various sectors and regions. While artificial intelligence is likely a driver of long-term value, it has not had a significant impact on current earnings. By way of another example, major European economies such as Germany's and France's are still struggling to achieve the projected growth in their respective year-to-date performances in their respective markets. The possible onset of inflation in Japan has also become an increasing concern for investors. It may be a bit premature to declare that the foregoing factors will result in a quote-unquote no landing outcome, where rising interest rates do not catch up to economic activity. Rather, it is likely that we have not seen the full impact of high interest rates yet, and a recession may only be preventable for so long. Thank you for watching the latest episode of Wahed Wealth Digest. Stay tuned for the next month's commentary as we continue to see how the markets unfold in September.